All right, what's going on, everybody? This is your man's the Trucking Trader, and we are back with another legendary video. Today, we are going to be talking about the most important things to identify in market structure. Right, this module is going to be really based upon the premise of looking towards helping beginner traders, right? Educating beginner traders on determining the trade direction. This is probably one of the most reoccurring things that people do not understand. This is probably one of the most talked about things to understand as a beginner trader. I sure remember when I was a beginner trader, it was very confusing for me to identify market structure and to understand the direction and price. So what is the primary function as a trader, right? As a forex trader, you're going to be learning how to find your way through price. And as a new trader, I can understand how, intimidating this may be for many new traders. Like I said, I was once there. I was just there not even too long ago, right? There are so many different time frames, right? You have the monthly, the weekly, daily, 4-hour. You got the 1 hour, 15 minute. You got the 5-minute time frame. You got the 1 minute time frame. And all of these things can be a lot for a new trader to grasp, right? So in this video, we're going to take our time and we're going to break things down step by step for everybody so that you can learn how to better understand market structure, right? So your primary objective as a new or beginner trader is to know your time frame that you're going to be trading, know what type of trader you plan to be, right? Are you going to be a position trader? Are you going to be a swing trader? Are you going to be short term? Are you going to be like a day trader or a scalper? So my goal is for this video to be able to teach you how to find the correct style of trading for you, figuring out what fits your personal makeup, right? Because we all have different lives, we all have different schedules, and my goal is for this video is to give you more insight that will help you be able to determine what it is you need to be focusing on to find the most optimum way of trading, right, for yourself. Because like I say, each of us are different. We all have different paths, not only to life, but we're all going to have different paths to trading as well, right? We all have different levels of maturity. We all have different levels of patience. All of these type of things are things that need to be considered when you're trying to figure out what type of trader you're going to be. So for me, for example, I tried swing trading. I didn't really like it. It wasn't enough opportunities. I didn't really like sitting in a trade for 2 or 3 days at a time. When you're learning these things about yourself, it's going to be best that you test some things out, right? Because that's the ultimate way for you to know what type of trader you're going to be. So my advice for new traders is to stick to the short term, to day trading or scalper time frames, mainly because these time frames will give you immediate feedback, and this is going to allow you to grow a lot faster. This is going to allow you to see some of these patterns play out a lot more, and this is going to give you the confidence to learn how to stick with your plan, right? Because obviously, as a position trader, you don't have a whole lot of opportunities materializing in the markets, right? The frequencies of your trades is going to be a lot less, but that can still be good for you if that's your style. But in these markets, when you're first starting to learn, you want to become active in the markets. And I'm not saying go in there and risk your real money, but what I'm saying is you want to be able to maybe practice on a demo account, or you want to be able to watch the markets as much as possible. It is going to be much harder for a new trader to find themselves waiting for a setup for days or weeks at a time. And then if they do get into that trade, it's going to be even harder for them to trust themselves to be in that trade for, days or weeks at a time, right? So this is why I typically recommend starting off on a smaller time frames, right? Short term to day traders, because like I said, that's going to give you more immediate feedback and help you learn a lot faster. So let's talk about what the professional perspective is when you're applying market structure, right? Well, obviously for position trades, this is going to be anywhere between 3 to maybe 6 to 8 months to a year in terms of duration, as far as like holding onto a trade, right? Taking a position and holding onto it. I don't have a whole lot of types of trades like this that I've taken personally. I have never been in a trade for that long personally, but that is what position traders aim to do. Specific swings that manifest itself. And, we have talked about this in other videos about teaching, and we're not going to really cover that here. But if you are that type of trader, obviously the 3 time frames that you will utilize to break down market structure for your particular market will obviously be the monthly time frame, the weekly, and the daily. The monthly being the highest time frame, your weekly being the midline, the midline or maybe the mid-level time frame, and then your daily will be like your short term. And then now as a swing trader, okay, our premise as a swing trader, our premise for breaking down market structure will be comprised of a look at the daily, the 4-hour, and the 1-hour chart, because your setup will be based upon what you see on the higher time frame. Then we have the short-term position trading, which is your highest time frame is going to be the 4-hour chart. Your midline is going to be the 1-hour, and the time frame, your lowest time frame that you want to go down to and look at is going to be the 15-minute. This is actually probably my most favorite time frames to trade right now, the 4-hour, the 1-hour, and the 15-minute. Mainly because I feel like the 4-hour and the 1-hour, it has a really powerful effect in the market versus like if you're looking at day trades and scalps, your highest time frame is going to be 1 hour. Your midline is going to be 15 minutes, and then your lowest time frame is going to be the 5-minute or the 1-minute chart. And there's nothing wrong with trading these smaller time frames, but what you will eventually notice as you go into the market and study is that the lower time frames does not hold the same level of respect or power as the higher time frames, right? Meaning that you're going to experience more losses trading the smaller time frames than you will trading the higher time frames. But when you're trading the higher time frames, you have to have a bit more patience. So let's take a look at price action and market structure. The keys to multiple time frame market structure and what you need to be focusing on. This is pretty much a very simple and straightforward idea. So the highest of the 3 time frames is what you should mainly be focusing on. Trades will be managed by the highest or middle time frame. So for example, I told you guys what my favorite time frame is, like the short term, right? Or the intraday time frames, which is essentially my highest time frame is the 4-hour. My midline is the 1 hour, and my lowest is the 15-minute. And you guys see in many of my trade breakdowns, I'm always on a 4-hour chart. I'm always on a 1-hour chart. And I always go check the daily just to make sure I know where I'm at. But I mostly do not take my trades from the daily time frame. Okay. The shortest time frame will be used to enter and signal potential reversal clues. So if you're a swing trader, your shortest time frame is going to be the daily time frame, right? So you're going to be entering the market from like daily order blocks or daily fair value gaps. If you're a short-term trader, like I say, your shortest time frame is going to be the 15-minute chart. Like, so me, you know, I sometimes I do enter from the 15-minute. Mostly I like to enter from the 1 hour chart myself personally. But essentially, whatever trader that you are, these are the rules that you want to eventually learn how to follow, right? The highest probability trades are made in the higher time frame directions, you guys. So I was just trying to explain this a little bit earlier. One thing that I noticed when I started to have success as a trader was that so for example, everything happens on all time frames, right? And this is why it don't really matter what time frame you trade, because price is doing the same thing on all time frames. It just looks different on different time frames, all right? But it's essentially doing the same thing. It's the same liquidity sweep. It's the same targeting fair value gaps. It's the same thing if it's going towards order blocks, right? It's the same thing on all time frames. But what you will notice when you're applying these ICT concepts is that the higher time frames work better. So for me, I had to find a mid ground because I did not want to be on the weekly. I did not always want to be waiting for the daily setups to happen, right? Because daily setups happen maybe once a week, maybe sometimes twice a week, depending on how fast the market is moving. But if I'm on a 4 hour or the 1 hour, now I'm getting 2 to 3 good trades a week, which is essentially all I need to maybe pass a prop firm challenge or something of that nature, right? All trades are framed over the key support and resistance levels, and market profiles will also, they will assist in market structure and analysis concepts, you guys. So what does that mean, right? You want to eventually go and learn how to go into the market and find the key levels of support and resistance. Now, I'm not talking about retail support and resistance. Typically, what you're going to notice is that support and resistance zones, and I want y'all to write this down. Support and resistance zones is going to be more like, the market going into an order block or a fair value gap. You're going to notice there's different things that's going to act as support and resistance. So when we are talking about market structure, right, what exactly are we talking about? So I'm going to use this chart to try my best to explain to you guys what exactly market structure is and how you can start to implement this in the real markets, all right? So now the red line up top. Now we're going to act as if that is resistance on the higher time frame, all right? I'm not going to give you guys a specific higher time frame. Just imagine it being whatever, you feel like may fit your trading style, right? So, for example, like if this was me, that red line would be like a 4 hour resistance zone, right? Maybe a 4 hour order block or a 4 hour fair value gap, but it could be anything depending on the type of trader you are, okay? So when you are looking at this, right, what you want to start to notice is that the market is going to go up into these higher time frame areas, and then what you're going to start looking for is market structure shifts, right? So as you guys can see in this example that I made, the market goes up, it hits into that higher time frame, and then we start to see some swing lows being broken, right? And then, from there, we can look for maybe an optimum trade entry. We can look for a fair value gap. We can look for an order block or something of that nature to then get in the trade, right? This is something that I literally show you guys in mostly every video where I'm taking a trade. I'm going through these exact same steps. And then obviously the same thing can be mapped out if we're looking for a support zone on the higher time frames, right? Let's say that red line is going to be our support zone. It could be the daily, it could be the 4 hour, it could be the 1 hour, it could be the 15 minute, right? When we see price go into this support zone, the next thing we're going to look for, right? Because we don't want to just take our first trade from just a support or resistance zone by itself. We're always looking for a market structure shift. And what that is going to look like, a previous low or a previous swing high or swing low being broken. In this case, we're going to be waiting for a previous swing high to be broken, and then we can start to target some of the previous swing highs that we seen in the market when the market was coming down, right? Because when the market was trending down the first time before it got into that support zone, that is going to leave liquidity in certain areas, right? That's going to leave and you're going to see that in the form of wicks. You're going to see that in the form of equal lows or equal highs. In this case, it will be equal highs, right? And then we're going to be looking for a market structure shift to take that market back up, targeting some of the old highs, right? So this is essentially what you guys want to start looking at when you're in the markets, right? Because what we're looking at on this chart, and I know it's not the best example, right? But as you guys can see, when the market was coming down, we have typically the market moves in three ways, right? It's either uptrending, downtrending, or it's consolidating. Consolidating is just simply sideways price movement, okay? Downtrend is lower highs and lower lows. Uptrends is higher highs and higher lows, right? And you have to obviously be able to identify a swing low and a swing high. I do have videos about that as well. We're not going to really talk about that too much in this video. But notice how when that downtrend started to happen, we had consolidation, and then we seen that the price broke below the swing lows. Then we had consolidation again. Then we had another break below swing lows. And then eventually we had the market find a support area, right? And when it was in that support area, let's say it was consolidating for a little while, you don't just want to get into the trade immediately after it hits a support or resistance zone, because even though you may be in the right direction for that trade, you just may be in too early. And then, as a beginner trader, you could just freak yourself out. You might end up taking a loss that you could have avoided and everything else, right? And this is going to lead us to another video where I'm going to talk about how to use time and price when you're using these concepts as well. But in this video, I just specifically wanted to leave it on market structure because I don't want to make a video that's too long and too intimidating for somebody that's new and trying to learn what market structure is, okay? So essentially, what you have to know is you have to know how to find support and resistance. You have to know what a market structure shift looks like. And I'm trying my best to show you guys in this example right here. But I do have other videos where I talk about market structure shifts all the time, because that is something that I utilize literally all the time when I'm trading. I'm mostly looking for a shift on the hourly or the 4 hour time frames in order for me to get into a trade, right? That's the time frame that I'm comfortable with, mainly because it has a really high strike rate. And I know that more times than not, I'm going to win the trade if I just be patient and allow that trade to set up. So we are reaching the end of this video. If you guys like this video, make sure y'all leave a like, drop a comment down below. Tell me if it was actually helpful to you or not, and subscribe to the channel. I appreciate all of you guys for supporting me. I do not take that for granted, and I hope that you was able to get some gems from this video. Peace.